Good morning, all. Welcome to the Genghis Weekly Investor Briefing. My name is Daniel Ogutu, and I'm from the marketing department. Welcome. In this briefing today, we will be going through what happened during the last week and what to expect in the coming week. And our presenters this week will be our head of research, that is Churchill Ogutu, and Kevin Ngige, that is our senior equities analyst. And today we will not be having Matthew Kabehere, as he has taken a break, and therefore Churchill, maybe you can start us off on the presentation today. Should you have any question, you can kindly just go to the Q&A section and post in your questions. Some will be answered during the session, and then some will be taken at the end of the session. And yeah, Churchill, over to you.
Thanks, Dan. Please enable sharing rights.
Dan?
Thanks. Okay, good morning, everyone. So I'll walk you through the macro and also the fixed income segments, and then Kevin will take it up with the equities side. So to start it off, the review for last week, we received the purchasing managers in.
Can't hear you.
One, two, three, testing. Am I audible? Am I audible?
Yes, you are. Yes, you are, Churchill.
Okay, thanks. Sorry about that. So let me start it off with the data that came out last week. That's the Purchasing Managers Index, PMI, for the month of March. And it hit a 9-month low of 50.2. It was derailed by export orders just because of some of the panelists who were surveyed for this index attributed to constrained cash flows issues, and also secondly, output index. So those two sub indices account for roughly 55% of the overall PMI index. So that's what also partly dragged the PMI to a 9-month low of 50.2. And nonetheless, looking at the outlook for this week is quite light. We are just expecting the fuel pump price review. That will be on Wednesday. I think there's also a special sitting in Senate just to discuss the division of revenue bill, the allocation between the national government and the counties of the ordinary revenue that is expected to be collected in the next financial year. So moving on to the fixed income segment. A review of last week, we are seeing that the turnover reduced in the order of 68% week on week to 3.6 billion. That could be partly explained by the infrastructure bond that was on sale, that closed out in the end of last week. The trades that in the secondary market were majorly on the infrastructure bond papers, hardly not surprising in light of the infra bond that was on sale over the course of last week. In terms of T-bills, we saw an overall performance of 84.8%. In aggregate terms, that was 20.3 billion. That was an improved performance from the 29% that we saw in the prior week. And looking at the yields across the three tenors, that's the 91-day, 182-day, and 364-day T-bills, we saw that on a year-to-date, they have climbed by 0.57% on average. Moving on to the liquidity indicators, average interbank rates are declined by negative 0.79% week on week to an average of 4.67%. In terms of the open market operations in the first half of the week, that's between Tuesday and Wednesday, CBK came to mop an aggregate of 50 billion, whereby they received bids of 33.1 billion and accepted 28.1 billion at a weighted average rate of 6.28%. Just telling us that in the first half of the week, liquidity was quite, there was improved liquidity that necessitated the CBK to come to mop up the excess liquidity. Between Thursday, Friday, they stayed out of the open market operations. Net domestic borrowing, currently we are looking at 410.8 billion, which represents 76.1% of the target of 540.1 billion. This, of course, was boosted by the infrastructure bond that came out last week, but next week we're expecting a maturity of FXD1 2016-5, which is the first 5-year paper that was issued in 2016. It has an outstanding amount of 19.1 billion. I would expect it will mature next week on Monday. So that will be a drag on the overall net domestic borrowing. But nonetheless, I think comparing to on a prorated basis, we are more or less in line with the net domestic borrowing target. Getting on to the bond issue, yes, this is the bond issue that was on sale this month. The results that came out, they were seeking 60 billion. Tenor was 18 years, weighted average life is 13.5 years. From the simple fact that on the 9th year, 50% of the bond will be amortized. So just looking at the overall weighted average life of the bond is 13.5 years. The coupon rate was market determined. So the results came out last week. Just looking at the results, total bids that were received was 88.6 billion. Of which 81.9 billion was accepted. So only roughly 5 billion was rejected. Saying that the coupon rate, which was the weighted average rate of accepted bids, was 12.667%. And because it's a new paper, so the dirty price, the clean price is still for every 100,000 that you're investing that you placed in as an investor, that's the amount that you will be able to deposit to the CBK, the value that is today. So that now ties in with the pitch for the week's trade. We are looking at a buy at the infrastructure bond. The secondary market is expected to kick off in earnest tomorrow, and we are seeing attractive entry levels on the paper. This is basically stemming from the fact that now the yield of this paper is expected to gradually decline and from the auction levels. So we are looking at levels of 12.4 to 12.5% that you can be able to enter into this paper in the event that you missed it out in the primary auction. So let me stop it there. Kevin, you'll pick it up with the equities.
All right, thanks, Churchill. Thank you, Churchill. Let me just share my slides. You can see that?
Yes, you can see. You can proceed.
Okay. All right, perfect. So, morning, everyone, again. So we are going to do a recap of last week. NASI down 1.3% to 158.59, and NSE20 up marginally 0.2% to 1,868.78. Turnover was down 20.5%. Again, we saw outflows from foreigners to 2.1 billion, and the top gainers were BK Group, which, as the NSE CEO said, trades more here than actually in Rwanda, Car in General, and Total. So top losers, TransCentury, East Africa, Portland, and IRET. Total, we saw it climb marginally due to the good performance they had, especially during the half of last year, and a good dividend, I would say, at 1.57 shillings. Foreign activity, so 75.53 net outflows. That's accumulation of buys on KCB Group and Stanbic Holdings, exits on Safaricom. We saw it touch lows of 36.5. Equity Group and EABL. Top traded Safaricom, Equity, EABL, KCB, and Stanbic. Kenya's year-to-date performance, 4.26. I think we've seen this come off from highs of 9%. Of course, we are lagging Ghana and Uganda at 17.6 and 5.3% respectively. Again, ahead of Tanzania and Zambia at 2.86 and 2.78% respectively. So corporate actions this week, I think some have been mentioned. I&M Holdings, 2.25 final dividend, 15. I think that's tomorrow. BAT Kenya, 41.5 shillings final dividend. That's on 16th. NCBA Group, 1.5 shillings. We have KCB, 1 shilling. Stanchart, 10 shillings and a half. And Kengen, 30 cents final dividend on 29th of April this month. So again, more on corporate actions. We have Stanbic, Kakuzi, NSE, Total, and Umeme. That's between 21st and 25th. Up to 25th of June. Equities trading ideas for the week. Long-term buyers towards strong stocks. Those are our blue chips. So we still have a long-term buy on KCB, dividend yield of 2.6% against the banking sector average of 2.5%, return on equity of 14.4% against the banking sector of 10.4%. I think that's it on the equities desk.
Thank you very much, Kevin. Now we head on to the Q&A session, and Wallace has started us off with a question about I&M, whereby I&M made announcements that the company performance projection. Maybe Wallace, you can maybe rephrase your question because they seem not to understand it. It's like a statement. But Moses is asking, with regards to the NSE 20 and NASI index, are these multi-year lows an indicative of buyer's market? Kevin?
Sorry, take that again. I didn't catch the last bit.
With regards to the NSE 20 and NASI index, are these multi-year lows an indicative of a buyer's market? Like, I think, is it a buyer's? Yeah, you understand.
Yeah, I think my answer would be yes and no, and maybe just to chip in on this. As we are currently, the fundamentals that we look at when you're looking at these stocks are not really what's at play right now. So we all know we have the general pandemic. I think we have, I would say, what we had again, sometimes the financial crisis around the 2008 time. I would call it, quote unquote, another pandemic. And these times are extraneous times that tend to see valuations flow. So I wouldn't really say that should be a signal per se. But yes, it's a good time to get in. Of course, they say get in when everyone is wary and get out when everyone is excited. So I would say that's a good time for me. Churchill?
Thanks. Thank you. Elaborated enough. Just to add in, because we're looking at it in terms of the other market comparisons, because looking at the relative metrics, be it price to earnings or dividend yield that we track on our weekly webinars. So looking at even the multiples, it might seem that Kenya against the other peers, it's slightly overvalued against metric like price to earnings, because you're looking at that percentage of the price of the Nairobi All Share Index as a percentage of the earnings that you'll get from Nairobi All Share Index as a basket, and comparing with the other peers. So the price are still quite elevated in comparison with the other sub-Saharan African peers. So from that perspective, it's more contrarian because it should warrant a sell. But nonetheless, if you look at the specific counters, you're seeing that some of the prices are at cheap records lows. So that's also another thing that perhaps investors might look at it, that it's quite attractive on the specific stocks, not just the basket, not on the basket of the index as a whole. So yes and no, still just to reiterate what Kevin had said earlier on. So back to you, Dan.
Wallace rephrased his question and is asking, do we expect the I&M share to appreciate further?
I don't know. Again, maybe my sentiments could be different with Churchill. I foresee it actually plateauing or maybe even falling off, because what investors or shareholders forget is, yes, we have a 1-for-1 bonus share, and that's the excitement on that, again, coupled with the bonus, with the dividend, is making the share rally. But once that bonus share has been accounted for, the real price will actually reflect that dilution. So I don't really understand what the hullabaloo is all about. I&M, yes, is a solid company, and we've seen traditionally that post bonus shares and post dilutions, the price at times always gradually goes back to levels where it was, and thus you'd see a capital gain. But I think investors who are really short of ideas, and the excitement on these and them has just been over the roof. Churchill?
Thanks. Let me just leave it at that point because I'll be regurgitating what you've just said. So yeah, perhaps we can move to the next question. Thanks, Kevin.
Yeah, Titus Kinyanjui is asking, which sectors will absorb the COVID restriction better in the coming months?
Oh, let me take that one. Titus, that's a great question. And it's actually a tricky question in terms of the sectors that will really absorb the COVID restrictions. Looking at, okay, let me start with the ones that which are outliers, which will bear the brunt of these things like hospitality industry, things like the beverage, alcoholic beverage. Just looking at the containment measures that were introduced 2 weeks back. So the sectors that will mostly absorb this one, it's really hard to tell because there's that second round impact whereby people are not fully back to 100% operations. So that definitely tends to drag even the consumption of the other sectors that might not necessarily have been negatively impacted from these containment measures. So it's quite a wild card to throw it out there. For instance, we've seen there's been some rebound in activity in the financial sectors, services, in the banking sector. We've seen that this gradual recovery to pre-COVID levels, looking at the private sector credit growth, for instance, at a 55-month of 9.7%, that is at the end of February. But now if you throw in this monkey wrench of tighter containment measures, you'll expect that banks will now go back to their cautious lending stance, and that will somehow dry up the juice that we've seen in terms of the recovery that has happened so far, at least in the recent past. So it's a bit hard to tell. We just have to wait out and see. And what is the main unknown in this scenario is the second round impact of other sectors that we still haven't been able to map out. So let me just say that there's still a cloud of uncertainty across all the sectors. COVID-19 is still not yet out, haven't been fully smoothened out. So that just introduces this layer of uncertainty.
Okay, thank you, Churchill. Moses Njuguna is asking, what is your view on the 2021 GDP growth of 7% estimate by the government and inflation outlook, as the private sector believe inflation will stabilize at current levels according to news article?
Thanks, Moses, for this question. And if I may take you back, everyone, to our playbook 2020, and then our estimates, our in-house estimates, we were at around 5%, and then we threw out a poll to the audience who are participating in the playbook. And the consensus was that growth in the current year will be between, is it 2.5% to 5%? So that's where the consensus lay amongst our panelists. So, of course,
we seem to have lost Churchill.
Yeah, seems like we've lost Churchill. So
maybe I can step in.
Yeah, please do.
All right, so yeah, I think he was making reference to our playbook and the consensus estimate that guys gave, which was between 2.5 and 5%. Ideally, and traditionally, that has been the floor and the ceiling for the government as well. It's usually plus or minus 2.5 above the 5%. So it's all the way to 7.5 or 2.5, and Churchill is back. He can take over. Churchill?
Sorry, guys, I just got cut out briefly. So the point I was speaking about the growth in terms of where people are actually untying to the question that had been brought by Moses in terms of where is this 7% coming from? Because looking at the broad contours of the sectors, there's that COVID-19 is still not yet out, so it has a dampening effect even across the sectors, be it mainly on the services sector, be it industrial sector. So that is expected. So looking at mainly where the 7% is coming from, and that has also been acknowledged by the authorities, is the base effect. Remember that, for instance, last year, second quarter, we had a negative 5.5% decline in the growth that was reported. So comparing with this year and looking at even the second quarter last year, what had happened about hospitality industry was at a complete shutdown. Of course, even right now, the outlook is uncertain. The education sector, schools were fully closed, apart from people engaging over Zoom or with the online channels. But that component that the schools were closed and some of the employees or the ecosystem around the education sector was negatively impacted. So even what the authorities did, by authorities here, I mean the Kenya National Bureau of Statistics, they had to change the methodology of accounting for education. So if you strip to the core, the laggards of second quarter last year, education was quite key, and then hospitality industry. But right now, in as much as there's that cloud of uncertainty with the schools have been shut down, even as we get into the second quarter, at least there's an expectation that there'll be an improved outlook. So basically, it just boils down to base effects last year compared to this year. But still, there's still uncertainty over the outlook, but nonetheless, this 7% is coming from the base effect. I think the other question that was tied to this was issues around inflation. And just as a commentary, I may say that last year, what we saw was a disinflation. By disinflation, I mean that if you compare between April up until September, the inflation data for last year, you could see that it was gradually coming down from the time that the inflation print was rebased. By rebasing is now they used a different base month from February 2009, and then it was the base year was now base year and base month was February 2019. And if you look at if I take you back to the inflation data that was there between April up until September, which stood out for us, there was that disinflation trend. And still the base effect kicks in. If you think about it, if it was gradually coming down, and this year, leaving everything constant, you expect because of that perspective, that trend this year will now start to go the reverse. So that's the negative, the inverse relation, the base effects kicking in. But that said, I still feel that it will be within the levels that even the authorities are looking at. The band is usually between 2.5% to 7.5%. Looking at the fuel inflation data, I think it's close to 15%, and still the near-term outlook for it will still go up. And that will have a knock-on in the overall inflation, which is quite monitored, which is monitored by the authorities, be it KNBS, be it CBK. But nonetheless, I still expect it to remain within the 2.5% to 7.5% band. So back to you, Daniel.
Thank you very much, Churchill. Stephen Gasheru is asking, I&M recently announced a bonus issue for 1 bonus share for every ordinary share. Maybe you can, Kevin, you can expound on this and what it means.
Yeah, so a bonus share is basically from the word bonus. It's an additional share based to what you own. So a company may do this for various reasons. At times it's just to spruce up sort of attention or confidence in their stock. So what this means is if you hold 100 shares of I&M, by the terms, by the registration date or by the book's closure date, or what you're going to own post that is 200 shares of I&M for free. So you're not going to pay this unlike how you pay for a rights issue. So it's an additional share for what you have. Traditionally, we've had 10 for 1, 5 for 1, and then we're gracious enough to have it for 1 for 1. And 10 for 1 would mean for every 10 shares you hold, you'll get an additional share. Or for every 5 shares you hold, you get an additional share. So basically, that's what the bonus share in I&M means. If you hold 100 shares past closure date, you're going to own 200 shares. Was that it?
Yeah. I think that is now easy to understand. Another question from Richard Mwangi. What is keeping Centum at these depressed lows? An accumulation of the same, can accumulation of the same be recommended? And finally, is it time we folded up our legs on and exited on KPLC?
I think I'll touch on both and maybe let Churchill conclude on those. Starting off with KPLCs, we've seen quite some confidence in KPLC, just mainly for the fact that it's an SO, it's a state-owned enterprise. And the thinking outside there from retail and institutional alike is that as with all the SOEs, we've seen companies like Uchumi is still listed. We have Momias suspended but still listed. We have Kenya Airways as well, suspended but still listed. And of course, then Kenya Power and Kengen. So the thinking behind most of these SOEs is the government it's a strategic asset for the government, and the government will always come in and chip in. And we've seen that a couple of times with all the other SOEs that I've mentioned. And I think thanks to that, guys have really been speculating with it a lot. So, and of course, there's also additional coverage or mentioned by the IMF. And I think Churchill had mentioned that in terms of some of the mitigative measures that are going to, that the state should put in place to sort of protect or address some of these cash flow issues with these state-owned enterprises. So on that, to me, it's always a speculative buy. I don't really see the return on holding the share, but at the price, it's really attractive, I understand. So Churchill, maybe you can add to that.
Thanks, Kevin. So from my perspective of Kenya Power, it might be a bit high level. By high level, I mean from a macro perspective, and looking at what's even the cross currents that are happening right now. What Kevin has mentioned, KPLC, touching on the state-owned entities, and even what the reading, my interpretation of the IMF report that came out in related to the facility that was disbursed in April 2nd. So one of the things that they mentioned that will come out is there are some of these state-owned entities that have been identified to be restructured so that they could be able to improve the efficiency. There's a report that is supposed to come out by next month, and KPLC definitely is one of those entities that will benefit from a restructuring of the 7 key state-owned enterprises. So it's just a wait and see to see the extent of the restructuring. Secondly, also still related with the multilateral lenders, there's still another facility that is coming from World Bank, $750 million. I don't know whether there'll be a hashtag related to that. Anyway, that's just a matter of conjecture. But my point is, there are some 4 critical areas that will be addressed with this facility, and one of them is now energy reforms. So who knows whether restructuring of KPLC or some added emphasis focus area on which will benefit KPLC will come out from this additional loan. So two-pronged approach, basically from the multilaterals. From one side, IMF is really keen on seeing a restructuring. Also, this facility that's coming from World Bank, just seeing restructuring. But in terms of the fundamentals, I still feel that it's still they haven't come out of the woods yet. They're not yet out of the woods yet, but still with the new management, there's some efforts that are being steered at least to bring back the company back to where it was. I don't know whether the question about Centum was addressed.
Maybe before I get to that, Churchill.
Okay. Yeah.
My friends and I, some of my friends were having challenges actually understanding. I know there haven't been much details on what exactly or what reforms exactly are going to be taken on state-owned enterprises, but from the precedents set by Kenya Airways, and we know now they're about to be merged together with KAA, some of them had concerns that Kenya Power would sort of be asked to merge with KenGen. If you can remember, traditionally, they were one company up until I think around, was it the 70s or 80s? When 97. Now, 97 also, yes, up until 97, when then the transmission was split from the generation. And we know KenGen as a solid company. We know KPLC for what it is. And the fear that if you're going to merge these two, it's sort of merging KAA, a profitable company, with KenGen. Does that affect the other PPPs, the private power producers, in terms of I've had KPLC buy expensive power from these PPPs, and those contracts are sort of cast in stone until their maturity, instead of, or as opposed to buying cheaper power from KenGen? Any thoughts on that?
Well, thanks. You brought an interesting point. I didn't see it that way in terms of whether this restructuring perhaps will be able to bring or take us back to where we were, Kenya Power and KenGen being in the same boat. Speaking about PPEs, let me not comment further about it, but I know that there's was it a panel or a commission, a committee that was gazetted. There's a committee that was gazetted 3 weeks back in terms of reviewing these PPPs. We haven't seen much outcome from that. But I think that is a step at least to address this issue that has been somehow hemorrhaging their revenues, because they have been forced to pay the PPEs, which has affected their net income. So let's just keep an eye on what will come out of that. Yeah. And also that restructuring, let's see what format it will take out.
I think some of also, just maybe to wind up, some of the thoughts from my friends was that if indeed it goes through, it's anyone's guess right now, but if indeed it goes through and KenGen is sort of brought together with Kenya Power under one umbrella, of course we'd have to see KenGen write off some of the debts that KPLC that they hold from KPLC, and that could be in tens of billions. So of course that would improve the cash flow for Kenya Power. And I think that would be a good thing for REIT going forward, and also get solid, solid management. We've seen that with their peers, the KenGen side. So anyway, let's see how that unfolds. I think there was a question on Centum. I don't think we've addressed it.
There's actually a question on Centum. Wait, let me just check.
I think the question was regarding the valuations, why they're at all-time lows, and would it be a good time to get in?
Yes, yes.
So Centum, I believe, has been, as an investment vehicle, it's one company that has, I think, is least understood, I'd say, or one of the least understood companies, because of their property valuations. And once you get onto their property valuations, then it becomes everyone's guess. While my thoughts are, or my sentiments is, I really don't like touching something I really don't understand. But we've seen that depressed, and we've seen even the CEO talking about how undervalued the company is right now, simply because, and he said it publicly, it's simply because guys don't really understand it, and how you account, how they account for revenue is a bit different. For instance, if they have a flat out and they're selling a piece at 15 million and you book at 5 million, and maybe Churchill can correct me if I'm wrong, is that say you've paid a deposit of 5 million for your flat, for your two-bedroom house, is that 5 million cannot be accounted for as revenue until eventually when you're given the keys to the apartment. So there's a way they account for that, and that's why at times in the media numbers that might not be accounted for, and then all the way to the end, after completion, then you're able to see that. Now the question has been, what happens when guys sort of default or are unable to raise the other 10 million shillings or whatever? So I think there's been one challenge about how they account for that revenue, and maybe that has been one of the key reasons why guys have shared off from their I rate. Churchill, any thoughts?
Thanks, Kevin. And I think at some point, Centum was part of the consortium that was looking at the coal project, the Amu Power project, but that didn't even pan out as expected. So that, over the course of time, at some point, contributed to the negative sentiment in the company. So just to take us back, circling back to what Kevin has said, and also I think one of the panelists, one of the participants had asked us, they brought this issue about the net asset value for the company, which is around 75 shillings per share. And that is what even the management for Centum has really been telling the public, that right now I think is trading below 20 shillings per share, and compared to 75 shillings per share net asset value price. So there's a steep discount in the share, and that's just to bring it a bit of high level. At some point when this issue about share buyback came up, the largest shareholder in the company was seen as one of the people who now snap up this share buyback, at least to be able to bring some level of confidence to the company, because as a single shareholder and one who has deeper insights in the company, he knows it has a signaling effect to the public, but that hasn't fully materialized, that share buyback plan, or what we had expected, that the largest shareholder in Centum will be able to take that advantage of. But obviously that will have a signaling effect if it materializes. So in terms of the pricing, I think it hasn't happened instantaneously. It's something that has been gradual over the years. I remember Centum was trading at 60 shillings per share, 70 shillings per share. That was history at the start of the decade, or just 2011 to 12 thereabout, but has gradually come down just because of perhaps the perceptions to the investments that they're holding. They recently issued a profit warning, and one of the things that came out is now, because of the capital gains, some of the exits from a profitable company, that was a one-off in the previous financial year. And this year they're not seeing any selling or exiting from the investments. So that has contributed to the profit warning announcement that was issued, I think at the start of last month, if I'm not wrong. So back to you, Daniel.
Thank you. Let me just see. Moses Njuguna is asking, do you think Bamburi will pay a dividend in full year 2020? Kevin?
I'm not too sure on that. I'm not too sure on that. Unless now we dig further information, and then we can be able to engage Moses on the side. I don't know what your thoughts are around it, Kevin.
I'm laughing because I know Moses pretty well, and he really looks into cements and actually covers cements. Hi, Moses. So I think I'll go with you, Churchill. I'm not too sure on that. We can look into it, but if you ask me, I think they could withhold it. We've seen how manufacturing and construction has really been hit hard. I was looking at EAPC's numbers, and I was also looking at the other cement manufacturer, I've forgotten the name, over in Nakuru. So I think due to those hits that, of course, coupled with the pandemic, and as Churchill was mentioning earlier, I think you mentioned something about the new strains. And I was just reading a piece yesterday on Reuters that were talking about the South African strain being more resistant sort of to whoever. Actually, it was worse to someone who had the vaccine than that who was unvaccinated. So it has become a really, really serious strain. And of course, that advises all the travel advisories. We've seen that from UK and America. As such, I don't really see I'm not as optimistic as everyone is in terms of, this year we might contain it, or probably by next year we might fully contain it. I'm a bit skeptical on that. But just looking at that, and with that as an umbrella thought, I doubt Bamburi would issue a dividend. I think they would want to preserve as much capital as they will. But then again, we'll look into it and get back to Moses fully. Thank you.
Okay, from our Facebook Live, Minesh Shah is asking 2 questions. What are the other stock picks apart from KCB? That is from our strategy this week. And then what are the sales in the market at this time? What counters can we sell at this time?
Okay, I'll let Churchill take it first, and I'll maybe just add my thoughts. Churchill.
Thanks for that, Minesh. I'll put it this way. Our overarching theme in terms of investment is just to look at the stocks that can buffer this storm, COVID-19 pandemic. And then we get into the specifics on a weekly basis. So we have 3 key portfolios that you monitor. The first one is the momentum, which is it's a bit of a misnomer if you look at momentum in the strictest sense of the word. But in terms of momentum portfolios, ideally they represent those stocks that are quite liquid, where you can be able to enter in and exit as quickly as possible. So looking at names like KCB, Equity, EABL, and Safaricom under those that qualify in that stock. We have the income stocks, whereby they have historically been paying dividends of above 6%. I know this has changed with the full year 20 numbers that has come out, but nonetheless, we have those stocks that have been paying steady dividends. We have companies like on the banking side, we have Absa, Barclays Bank. We have Cooperative Bank paying decent dividends, and those also fall into this portfolio. And then lastly, we have the value stocks. By value stocks, we have those ones which are quite discounted by the market, whereby from a metric of price to book, looking at the price as a percentage of the book value, all this is a metric, price to book ratio. They are quite low as compared to the sector that they are in. So we have 3 counters. We have Kengen, we have Kenya Re, and we have I forget the other stock that we have, but I'll take it out in the course of this webinar. So we have 3 stocks that qualify there just because of their low price to book ratios, whereby we're seeing that has been quite discounted by the market. So those are the broad stocks that we have been pitching over the course of this year. Of course, there are some revisions that will be made in the course of this year, which will be able to advise the clients. But over and above the KCB that we picked for this week that stood out, we also have these other stocks that lie in our portfolios. I don't know whether, Kevin, you can weigh on this, or you can just pass it to Dan.
Sorry, I have a bit of a call, that's why I keep going on and off. I think mine is just to regurgitate what you just said. At times we see opportunities, especially when I'm looking at Safaricom at levels of, say, all-time highs of 39.5, and I'm like, boy, this is a good stock to exit. But when speaking to institutional, one of the common theme is, yes, we can sell out of Safaricom, but then get into what? There's sort of a dilemma there. You can sell out of, say, when KCB and equity improves. Yes, we can sell out and book that profit, but then what else do you get onto? When you're looking at the investable class, we're mostly talking about the NSE 20. These are the top 20 biggest company by market cap. And I think Churchill has modeled our portfolios right around them. And that's, of course, due to safety and liquidity and foreign participation in them, also local participation in them, regional participation. I think Churchill looks and his team looks at all those factors when coming up with recommendations for the portfolio. So yes, at times you may see, say for instance, Safaricom, you've gained your target, but the main question and theme we get is you're exiting Safaricom and getting onto what? So just that from me.
Okay, thank you very much, Kevin. Alex Mushoki is asking, what's your take on Britam and Cabaseed shares? Is the current price a good entry point?
Let me take that one on Britam. I'll just tackle on it from the corporate actions that we are expecting. From what I gather, I understand that the full year numbers for Britam will be out sometime this week. That should be either Thursday or Wednesday. But that's from what I gather, and it will be interesting to see what the results that will come out and the outlook from the management. So that's another thing that we'll be keeping an eye on. Mostly in light of the new management, there was a restructuring that had been priced in the market in Britain in terms of the executives, whereby we are coming Exco team, executive committee, are now getting into 12 executive committee team. So looking at the next round of the strategy in Britain. So that's broadly the outlook that we are keen to see from Britain going forward. And majorly, what's sticking out from Britain is now the asset allocation. You know that it's an insurance company, but it does also holdings and in some of the equity investments and also the property. But the new management has been quite adamant now to move away from these other non-insurance holdings and get into the core of the business. So the theme, or in regards to Britam, is now the strategy going forward, and that will be quite keen just to look out for. So I think from the numbers that will come out this week, unless anything changes, we'll be able to better see or how the outlook for Britam will be. For Cabaseed, I think that deal with the BOC gases is still in a limbo. The legal action that was brought against the transaction is still in the courts. So we are still looking at how will it pan out. So we will not be able to comment further. The transaction was meant to have been completed by last week on Tuesday because of the legal, the court action that is still out that hasn't been determined. So we're still in a limbo. So I think that's where it is in terms of the corporate actions around Cabaseed.
Thank you. Vincent Alila is asking, recently NMG announced a buyback of 10% of their shares issued. Have they said what amount a share they are going to buy them back, like the price, I think? Kevin?
No, I haven't seen detail. Unless I missed it, I don't think they've communicated more details on that. Have they, Churchill? No. So they're going to advise here.
Okay, Moses Njuguna is asking, why is the NSE hesitant in delisting entities like ARM or those that have reported significant losses reflected in their share price declines like Mumias and Uchumi?
I would say for a company like ARM, I think the administrators are still on their case and the administration is still ongoing. So maybe we'll await the results of that. And that once that is fully settled, I think maybe the CMA is going to advise further on whether to delist it or how it's going to exist. So we await guidance on that. On other companies like say KPLC and Mumias, they have been suspended pending government interference, for instance, on something like KQ, I'd say. So we're also waiting on that from the government. Churchill?
Let me tackle the second part of Moses' question, whether there's not been delisting of the companies that have the share price has eroded drastically. And let me just paraphrase. There's an interview that the NSE CEO did last week. It was quite brilliant. It was informative in regards to the outlook of NSE. And one of the questions that was posed was along those lines. And what he said is there's a difference between a public listed company versus a private listed company. So at least in as much as those companies' performance has been on a gradual decline, at least there's visibility in the companies, and that was quite critical. That was quite key to me. At least you can see that they're still continuing with the disclosures, be it as bad as they are, they're still, and that's quite critical. You can get some visibilities around it. And the question that he brought about was, say, issues around, say, Uchumi supermarkets. At some point, it was suspended. It was brought back to the market, but still, the share price has eroded drastically as compared to where it was listed at. But at least you have better visibility on the company that is still listed as opposed to whether it's delisted. And that's quite critical because there's not much of a requirement for a company that is not public to continue to continue its disclosures, be it on a half-year basis, be it on an annual basis. So to me, at least with the visibility, it could also be able to, the discussion is much more faster. Or I know from an investor perspective, there's a 10-year pull towards those companies, which perhaps they are deemed as penny stocks because of compared to where they are, their share price is at the moment as compared to where they were before. It's just they are classified as penny stocks. But nonetheless, that level of disclosures, as bad as it is quite, it's a good thing, if I lack for a better word. And that's, to me, really stood out for me. I know there will be some restructuring, there will be some way of improving the corporate governance where such has failed in those companies, but nonetheless, the visibility is quite important for us. So that's just reiterating the view of the NSE CEO.
Maybe just to add on to that, Churchill, I'm sorry, I have a call I'm struggling with, and I couldn't proceed further in my last statement. And just to address Moses, is the exchange is where there's something we call price discovery. And since the share was, or if a share was listed at 60 and it's not trading at 5 shillings, it doesn't mean necessarily it has to be delisted. That's where, as long as there's no manipulation and they've adhered, as Churchill said, to capital market guidelines in terms of if your profits are going to decline by more than 25%, you're going to do that. If they say a capital injection or something is happening in your company, you have to disclose it so that we all act on utmost best information that is currently available. So if you look at companies like Tesla in the US, or you generally look at the S&P 500, and you're going to see how tech stocks have been heavy on that index. Everyone, the talk around the US and with global investors is, of course, we're going to see some corrections, share price correction. We know there've been asset class inflation over there, and we've seen that, of course, in the S&P 500. And if I'm going to mention a company like Tesla, for instance, which has gone up more than tenfold. So we all expect there's going to be some sort of correction, and the SEC cannot now then come and say, we are going to suspend since the share has decreased by more than 10 times its listing price. So that is normal price discovery, Moses.
Thank you, Kevin, for your input. Kevin Kakuti has 2 questions. He listened to Churchill's view on fuel prices on news last night. And EPRA is set to revise the retail price of fuel this week. What's the probable trend if there is an increase? And then the second question, April's IFB bond was such a short notice. Can you engage CBK to ensure that offers should be at least 14 days before closing? Churchill?
Maybe I can tackle the first and let Churchill tackle EPRA and the fuel adjustments. So CBK acts as the agency for national treasury, which again acts on behalf of the national government. CBK does not come to us in terms of, there's something we call the Market Leaders Forum, where a few key guys from the market sit down with a few key members from Treasury, from CBK, and they decide which papers to flout or which papers to auction. Yeah, and that's how they advise this time that an 18-year amortized IFB would be the best bet. But in terms of the period of sale, which is he's talking about, in terms of which paper it's going to be, in terms of where the coupon would be, if it's market determined or not, where the yields would be, what value they're looking for, it's all at CBK's discretion. So that's not for us to advise the CBK on. Churchill, Lepra.
Oh, thanks for the question. And how can I say it? Let me acknowledge that I was seen on tail yesterday. I think it's on audio. So yes, we're engaging in person. So in regards to the EPRA, basically the price, and mainly that is the price of fuel products in Nairobi. That's why there's a bit of some granularity, the details, whereby they explain the rationale as to where the price, as to what happened to say the price is at 117 shillings, for instance. So if you look at super petrol, you look at diesel, you look at kerosene, that's the last review that we saw. 43% of that was on the landed costs. And I think 3% of that was on storage and distribution. And then another 11% was on the oil marketers margin. And then the other part, which is quite discerning, is now on the taxes and levies, another 43%. So that's the breakdown on average across these three products. 43% majorly on the landed cost, 43% of that is taxes and levies. So the last review, we saw that the average price that was the Brent, the benchmark product, that's ADNOC Maban, Abu Dhabi National Oil Company Maban, which was around $61 per barrel. Last month, remember we discussed in detail the issue about the ship that got stuck at the Suez Canal. And around that period, that spoke to the supply disruptions. It hit close to $70, $67 per barrel. So my point is that whatever is happening, whatever happened in March, the price action of oil in March has an impact even in the next fuel pump price review that will be hearing on Wednesday. So on average, I'm just saying that the price of the global benchmark, I still don't have the ADNOC Maban price. It's usually published with a lag, but I'm saying that it averaged close to $66 per barrel on average. So that means that the landed cost of the fuel pump products will go up from the $61 that we saw in the previous review. That's one aspect of that. And when you come to taxes, some of them are now additional costs. Some of them, like road maintenance levy, that's on the super petrol and diesel, that's standard 18 shillings per liter. And then we have anti-adulteration levy, that's for the kerosene, still at 18 shillings per liter. So those also adds the additional costs to the fuel pump prices and contributes to this elevated taxes and levies that we are seeing. Over and above these other base contributions to the fuel pump prices. The other thing that also came out, this issue about the value added tax, right now is at 8%, but now from the IMF report, we are looking at perhaps it's meant to be increased to 16%. From the macro level perspective, the IMF came and was keen on seeing a fiscal consolidation. By fiscal consolidation is that level of the budget deficit, the difference between spending and the borrowing. So that's the fiscal deficit. It has to reduce as a percentage of GDP, but how it reduces is not that we reduce the spending, but we increase the revenue. So the IMF have been quite keen on seeing that revenues are increased, and that also speaks to the fact that they want the VAT on fuel to increase to 16%, and that we still don't expect it to be reflected in the fuel farm pump price decision that will be out on Wednesday, because it has to go through the law. That's what we're talking about, be it Finance Act 2021, if at all it's implemented to the latter. But nonetheless, from the perspective that the landed cost will be higher in the review period as compared to the previous period, I'm seeing that there's a higher likelihood that we're seeing the fuel pump prices to be on an increase come on Wednesday.
I have maybe just if I could ask you a question, Churchill, just on the oil. We've seen discoveries that one, the President of the Republic of Tanzania, Samia Suluhu, is in Uganda for the signing of the tripartite agreement on oil. We know they're going to be constructing a 1,440 kilometers, if I'm not wrong, a pipeline from Tanga to Hoima. And of course, this is going to be the biggest electronically powered pipeline in the world. And the reason why it's electronic powered is, of course, due to the waxy nature of Ugandan oil, the Albertan oil. I have 2 or 3 questions on that. One is, I read somewhere that Saudis produce a lot of oil at $10 a barrel. But the cost of Uganda transporting this oil to Tanzania is going to be around $14 to $15 a barrel. That means if you're looking at everything holistically, you're just going to take around $35 to $40 to break even. Is that viable for you? One, is that going to address or affect us in any way? Will it make oil cheaper or easily accessible? Maybe you can just address it, Churchill.
Oh, thanks for that. I think that news item came out over the weekend. I haven't really analyzed deeply, but it will. Remember that even our Kenyan case, we had that early oil export scheme, the 200,000 barrels at some point in time, and we will be in that Tanga, Tanzania, Ugandan oil pipeline will be in direct competition, will be directly competing with our oil export schemes. So from the perspective that we will be importing, if that's the nature of your question, I think from that perspective, it will be a plus. But then again, there are some other added costs that will come around that. So I will still wait to see, perhaps one, the number of volumes that will come out from the oil that is coming from, and because that will even speak to their competitive edge, because I'm not too sure whether all the oil that Uganda will be drilling, all of it in its entirety will be exported. So I think they'll have some for their own internal consumption, and then just a small part of that is what they'll now be exporting. So I still don't have the numbers yet, but once we have the numbers is what you can now be able to see. And of course, it's a bit from the oil marketers' perspective, I think they have those long-term contracts from where they get their supplies off. So I don't think that they'll just suddenly cut it off so as to get into this other alternative new player in the near term. It could be gradual, but in the near term, I think they'll still stick out with their relationships that they have. Perspectives around it.
Sorry, I think we'd lost you, Churchill. Maybe that's something we could take offline and maybe just check, because from the preliminary results or news out is that Uganda discovered 6.5 billion barrels. I think that's way more than what we discovered in Talo. So that's going to be good for them. I know the deal is going to be around 3.55 billion. Not sure who is going to foot the bill for this, whether it should be shared between Uganda and Tanzania, or it will be, I saw there is an instance that it could be Tanzania offsetting this bill. And if we're talking about 3.55 billion, and they're going to be getting, I think it was around 300 million or 3 billion, I don't really remember the numbers. It was going to take Tanzania 30 to 35 years to just break even. And the question now that arises is, will oil or crude be still the reliant fossil fuel in 30 to 35 years? We know we've seen battery powers and all that stuff. So yeah, sure, we're going to take that offline and maybe we can dig more into the numbers.
Sure. Thanks.
Okay, thank you very much, Kevin and Churchill. Kevin Ngige has two questions. What would you rather have invested your money in 2021? He's looking for your opinions and reasons. And then the second question is, he invested money in ARM Cement shares back in 2018. And since it's suspended, does he lose money, or what happens in case the company is suspended in its entirety from the NSE?
I'll maybe take that. And there's one question I also think either we didn't address or I just saw it and I think we passed it. What would I have invested my money on in 2020? Again, my best pick is always Safaricom. Churchill will be a bit modest, maybe to mention some of the other names, but my best big pick would be Safaricom. And if I was going to add two more names to that, I think I'd go with KCB and or Cooperative Bank of Kenya. So Churchill will address more on that. There's also a question, maybe if you can just take it quickly, about Bank of Kigali and why we've seen different share prices in Kigali and here in Kenya. And we've seen that with also Umeme, where you find the share price trades on different levels in these two markets. I've forgotten the actual name for it, but what we tend to see, especially foreigners doing, is they'll come buy a Bank of Kigali here, one, due to the liquidity that is available in the country. And once they buy that, they then convert them and sell them back in Kigali. We know a share price in Kigali closed, I think, at 265 on Friday. The share price here, if you're going to talk in Kigali shillings, is around 225. So we have some 40, 50 shillings difference. And that's what guys who understand, of course, with all risks, currency risk and all the risks involved, who understand make a killing from it. Churchill?
Well, I'd go with you. Investing in 2020, those names that you mentioned, Safaricom, Coop, and KCB. I'll just go with what Kevin has said. I think there's a second aspect of that question. Dan, if you may just.
Yeah. There was a second aspect where he was asking. Wait, let me just get to it. Kennedy invested money in ARM Cement shares back in 2018. And since it's suspended, does he lose his money? Or what happens in the case the company is suspended from the NSE?
Well, Kevin, go.
Oh, sorry. I wanted to say, and it's a question we've been asked a number of times in terms of investor compensation fund. There's usually a charge on every transaction that we undertake that goes to the ICF, which is the Investor Compensation Fund. But one thing, I heard it was recently, I relooked the numbers, I think it was raised to 100 shillings. I knew it as 50,000 shillings. And what usually happens during when a company is undergoing administration is, of course, debt is paid in terms of seniority, yeah. So, you know, creditors with preference shareholders and all these bond holders or debt holders, of course, have to be paid before we get to the end of the rack, which is the common equity holder. So if there's something to be left out, we don't know. That's the administration to decide. But if there's something to be left out, then yes, it would go to the common equity holders in a specific matrix. But from the Investor Compensation Fund, you'd only be compensated, I think it's up to 50,000 shilling or 100,000 shillings. Churchill, anything to add on that?
I think that at some point we won't have suspension ad infinitum until infinity. Because just looking at even historical perspective, when you had Uchumi, I think the longest time it was suspended was for 5 years, between 2006 up until 2011, 2012, thereabout. So at some point, there could be a way of now bringing this item into a closure, the issue about ARM to a closure. But that's it, just looking at from a research perspective, and I just need to give a heads up to some of my previous colleagues who we worked with in the team at Genghis Research. I think in 2017, the analyst was covering the insurance company, just looking at the numbers, said that she wasn't convinced that what is being portrayed by the management is true representatives of the financial reports. And from there, it was a hard call for her, and she said that she'll just stop coverage on ARM cement. And true to course, I think a couple of months down the line, we saw that now the corporate misgovernance issue now came to a complete head and led to where we are currently, being in suspension. So it's also from the people who even understand the industry inside out can be able to give more visibilities around ARM, and not only ARM, but even in the stocks that are covered by analysts. So that was a good call, just to say. And most of the investors who followed that call from our analyst, just the decision to drop coverage on ARM, and they were able to now even exit their holdings. At least now they're in a better place. But not that I'm saying that I think it's Kennedy or Michael who asked the question that they did not hit the call. But the point is at least those red flags that not only Genghis Research puts out there, but even amongst our colleagues in the industry, those are some of the red flags that investors also need to be keenly monitoring on any of the listed companies. So back to you, Dan.
Yeah, Moses Njuguna has actually commented on in regards to ARM, and he says that the assets was sold to National Cement for $50 million, while a Tanzanian asset was sold to Hauxin for $160 million. And then the administrators have done their jobs, and technically ARM Group does not exist anymore. That's the question, that on why ARM is listed yet operationally it doesn't exist. That's the question. Why is ARM listed yet operationally it doesn't exist? They should be listed.
Thanks. Again, that comes from Moses. I told you I know Moses personally, and he's been looking at cements for a while, and that is indeed true. So there's the shares in Kenya and Tanzania. Thank you, Moses, for reminding me that was sold to. That's the cement manufacturer. I was trying to remember the name. It was a National Cement, and again, Hauxin at $160 million or 16 billion cash, if you like. So the question now is now clear in terms of why then is ARM listed, as it's been split and sold off while it doesn't exist anymore. And remember when we talked about how equity shareholders fall on the stack. So we fall at the bare low end of the stack here. So you have, of course, the preference shareholders, the debt holders, or the debt note holders. And of course, if there's anything to be salvaged from the company, especially with this $50 million to dollars and $160 million, that's around 210 or $211 million. That's around, I think, 21 billion cash. Is what from Moses and what I understand is that debt holders were paid a fraction of what they owed. Yeah. So assuming you hold 1,000 shillings of debt with ARM, maybe you're paid 100 shillings. What that means is that there's literally nothing left of for equity common holders. So if you're holding ARM shares, it's time to tell you, sadly, that you have to forget about it. And I think indeed it's going to be delisted. I'm going to check with the NSE, and just as the reason why it's not delisted yet, maybe there's something we're missing and we can address it next week.
Okay, Dennis Nzioka is asking, there was a lot of hope in housing finance shares, and the bank was giving a very good promises on performance after it went out to full banking concept. But last period, they have made more loss. Is there a share to is there a share to plan to buy? I'm not understanding this well, but those who had already entered, what would you advise?
Churchill, do you want to take that, or can I attempt? All right, so housing finance has been a pain on both Equity Bank and Britam for I think for the longest I can remember, since I joined this industry right around 2010, 2011. It's been a total pain for them. And depending on how it performs, it of course, because these are the two main or anchor shareholders. I think I had talks of the new incoming Tav or Taz, the new incoming Britam CEO, in terms of how he wants to span the equities holding to not, so that Britam can primarily deal on its main job, which is insurance. But holding stock, I think they talks about how they're going to churn that off. Maybe Churchill will add more meat to that. But it's for that main reason. I think they've tried all they can with HFCK. They've put in a new CEO. They've had a new 5-year, I think, strategy. I don't know how it worked or how it didn't work. I haven't really been following it. It's a penny stock, if you ask me. And I know for sure that both, especially Equity, has been looking for sort of a strategic owner to buy this portion of their book. So I don't know how far that has gone. And I think it's for all these reasons, the fact that there's not anyone new or new money coming, strategic money coming in, that HFCK has really been underperforming. Churchill?
Yeah, in terms of the risk corporate organization for HF, it's just a wait and see how, because what has been signaling the market is that Britam will exit its stake in HF. So it's just to see how it will be execution over the course, whether it's over the course of this year or over the course of the next couple of years. Just what's a wait and see from the market. So let me just stop it there. Back to you, Dan. I don't know whether you can wrap it up right now or.
Yeah, this is actually, there's one last question from Eunice Onyango, who's asking, what makes Equity and KCB be bumper to bumper in share pricing? Like when one goes up, the other one goes up. And then who is buying these KCB shares in bulk?
So Equity and KCB have actually been tracking each other for the longest time. I think there was a time I was watching it for around 3 years, and KCB, of course, was always edging higher by a shilling or two, mostly 2 shillings. So if KCB was 40 shillings, Equity would trade at around 30, 39 shillings. We saw from the recent numbers that, and of course, there's always been that bragging. Everyone has had those bragging rights in terms of we are the biggest bank, and you'll see some of the very funny names. You know, Equity would say we're the biggest bank by assets. KCB would come and say we're the biggest bank by customer numbers, and it will always shift. But looking at the full year numbers for 2020, I think equities are past the 1 trillion threshold in terms of in terms of assets. I believe traditionally one of the things that has made KCB really attractive, other than the fact that it has a significant government holding in it, and thus benefits from government business, which I think there was a change to that as well, has been their brick and mortar existence. So KCB owns, I think, and maybe Churchill can correct that, KCB owns most of their branches. I think from way back, Equity leases some of these, including their headquarters. They don't own it. So in terms of worst case scenario, a company unfolds or unwinds, it's we shareholders of Equity would expect to see a bit more. But Equity has been very efficient with shareholders' equity, so, and they've grown that significantly. I think we're going to see double digits again in return on equity, edging slightly higher or above KCB. So as such, I believe those have been the 2 strongest companies, and we've seen them and how they've been resilient during this period. Churchill?
I think Churchill has, for some reason,
disappeared.
Yeah.
All right. So yeah, I think primarily that's the reason. And maybe there's just a last question I can see my Mark asking, and maybe you can address that in terms of you'd like to know how much Genghis charges on brokerage fees.
Yeah. So
maybe we can wrap it up.
Genghis charges 112 for a brokerage fee. That's when you trade shares. No, let me check and communicate to Mark via mail on the full list of charges that Genghis charges when you buy and sell shares on the NSE. Yeah. So let's wrap this up. It has been a good session. Thank you very much, Kevin and Churchill in absentia. And should you want now to put to action the knowledge that you've gotten here, you can do it via our application called Jikuze, where you can buy and sell shares and also invest into our money market, that is Gen Cap Money Market Fund. And I would also like to say that we also have other webinars that we carry on through the month. That is the Genghis monthly financial chart by one of our very own, Kevin Ngige. You'll be on the lookout for that one also, and also the personal investment webinar. Okay, see you next week, and thank you very much for carving out your time on this very busy Monday to attend this webinar. Thank you very much, and have a successful investing week.